Most traders think crypto became a casino by accident. It didn't. It was engineered this way on purpose. And once you understand who built it, why they built it, and the actual architecture behind it, every single chart you've ever traded will suddenly make sense. Crypto is rigged. How elites designed a casino where traders always lose. And in order to understand what we see now in crypto in the casino, we have to go back to a time where there was no casino in crypto. We're going back to 2013. We're going back to the early years. So if you were suddenly dropped in crypto in 2013, it'd be very, very different. Back in the day, everyone was obsessed with anonymity. Nowadays, things are very different. I'm here talking in front of you. I'm pretty much doxxed. Things have changed, but everyone was obsessed with it. They only talked through this internet relay chat and Bitcoin, dusty Bitcoin forums. That's how it worked. When a new coin appeared, it's not like now that you can go on Pump Fund and buy it, or like Jupiter. There was no pre-sale. You either mined it or you missed it. So in order to actually get a token back in the day, you had to mine it, which is crazy, right? And this is why nowadays in crypto, a creator of a coin is called a dev, because back in the day, you actually had to like develop it and make real code in order to make the token, which was really, really crazy. So things worked very differently back then. It was more like a rebellion. It was more like a community rather than what we see now. It was very, very different. And the simplicity is that Bitcoin and Litecoin dominated the narrative. Conversation over forums and internet relay chat. So charts moved slowly because there was little to no liquidity. Days would literally pass between major moves. Now, as I said, this is not from my own experience. I had to research all of this, okay, guys? But this is what everyone says. People built because they wanted an alternative to banks, not because they wanted clout like we see nowadays on Twitter and on different platforms. And the vibe was mostly just curiosity. The turning point was really when Bitcoin reached about $1,000 per Bitcoin. And that's when people started to smell blood, like a shark smelling blood in the water, because volume actually started to arrive. And this spike made everyone realize that there was serious cash to be made. And this is what happens in every single industry where you have a group of individuals that have a very strong community and they really believe in what's going on. And then suddenly there's money involved and there's people getting involved. External actors who are profit hungry find out about the space and come in and start extracting. So new faces appeared, marketeers, exchange founders, funds opportunists. They didn't care about code. They didn't care about freedom. They just cared about profit. All they saw was an unregulated gold mine filled with emotional bag holders. And the unfortunate reality is that freedom became the product. Opportunists came up, exchanges popped up, the structure for speculation was built very, very quickly by these people. And by the time 2017 came along, mania had hit, the spirit and what the small community that we had in 2013 was completely gone. Literally completely gone. 2017 was a very, very different space. Crypto has transformed into a decentralized movement, into a globally networked casino, which is what we see now. In 2015, the ICO boom created tons of new tokens. Marketing was done on Telegram and Twitter, but the story didn't end here. The early culture didn't die by accident. Something else entered the system, something far more organized, and genuinely, this is where the real story begins. So, the blueprint of the casino, the fee machine. Exchanges are the backbone of the casino. They weren't created by those who are passionate, like I said. They were created by those who are interested in profit. And they solely profited from volume. That's the only way exchanges make money. They don't make money by you making any money. They only make money by people playing, which is why they always spin up new metas in order to get more volume, in order to make more money. Every click, every swap, every wick is a micro fee for them. Binance, Coinbase, BitGet, even decentralized platforms, they all run on the core same model. Volume equals revenue. On-chain dexes, which we got a lot of in 2021, and that bull market, they take their slice too, okay? So wallet activity and flow data are sold to upstream, to analytic firms and other companies as well. So it's not just volume that they make money on. They make money on your data too, which is crazy. And they're never going to tell you this, obviously. So this is just the surface layer. Exchanges needed a way of multiplying volume without users. So what's their solution? one of the most profitable inventions in modern finance, which you have definitely heard of, my friend. It is the leverage trap. Leverage is arguably the greatest invention of all the casino. Perps futures looked like they were helping investors because perps allow you, or they look like they allow you, if you have a little bit of capital, not much, you can double down, triple down, 50x down on your conviction on a coin that you actually like. And BitMEX was one of the first people to do this. There's a very, very famous quote. Mr. Arthur Hayes, who was the CEO at the time, he was quoted saying, "Run the stops for the remaining plebs. I need a new Ferrari." Which is really funny. And essentially what he's saying there is manipulate the price to stop people out, because these exchanges make a lot of money when traders are forced liquidated. Okay? And it pretty much sums up the whole leverage game. And by about 2017, the leverage meta had spread everywhere. It started with BitMEX, but then BitGet, Binance, Coinbase, all the other exchanges slowly started implementing it as well. And what happened was freedom and the ability to double down on your conviction turned into a literal printing machine for the exchanges. Market makers, probably the most nefarious actors in the whole of crypto, because in traditional finance, market makers are extremely regulated. They really have handcuffs onto their desk. They really can't do an awful lot. But in crypto, market makers are really like the Wild West. They can dump tokens, they can sell them, they can move them about. They can get, when a coin gets listed, they can send a load of tokens to the exchange and then dump the tokens and put on a 50x short. So many different ways market makers in crypto can make money. Most people don't realize it, but most charts in crypto don't move randomly. It's all orchestrated, guys. For larger coins, let's say 50 billion market cap and up, market makers build liquidity bands, spoof order blocks, and manage volatility like a conductor with an orchestra would. But with smaller coins, they're just built for extraction. They literally just own a load of supply and they buy and sell the chart, and they take about a 20% fee off every single buy. And then that gets split up between the team and the market makers as well. Typically the team take about 80%, market makers take about 20% of the profits. There's zero oversight. There's literally no regulation at all. They can do whatever they want. And they've been doing this since probably started in 2015, but it really took off in 2017 and 2021 as well. But even when volatility was engineered, they still needed one piece missing. They needed a way of funneling retail into the game of command. And here come in the KOLs, which you all know very well. So once the exchanges had infrastructure, market makers had volatility, they needed a way to distribute and communicate with retail. And that's where the KOLs came in. So the influencers became the sales force of the casino. They need influencers because these people, market makers and exchanges, need ways of communicating with retail. And they post in conviction, not truth. They have no fucking skin in the game. KOLs have no skin in the game. They get given supply, and then they post to their followers telling them to buy. So it's like a baby being given candy. It's the easiest thing in the world for them. They can just sell and they get given sell rules, while everyone else has to take a financial risk their own money, and risk losing money. These KOLs, they don't have any of that, okay? And that's what makes it crazy. The incentives are completely misaligned. KOLs are telling their audience to buy, they get given free supply, okay? And this is how it works, because the KOLs become the bridge between retail and the market makers and exchanges and the teams of the tokens. Every sponsored tweet, every community push is a giveaway and just a marketing tool for said coin. I do think retail is getting smarter, but there's always going to be a different way to package it. Maybe in the next cycle, they're not going to be called KOLs, they're going to be called something else. But it's important to be aware of it. I really think it's important for you guys to be aware of. But the real power isn't in the influencers. They do hold some power. It was much deeper. It's actually inside the tokens themselves. This is where the real power comes in. So behind every token is literally a spreadsheet of hidden control. Bundling matters where insiders and teams quietly hold over 90% supply. This is what happened with Brett, by the way, on Basis, why Brett went so high. Timed unlocks looked disguised as organic growth. The illusion of fairness. It all became a marketing tool. So very early with the meme coin meta, we had what was called fair distribution and a fair launch meta. But then later, a bundled meta was the one that came into fruition. A bundled meta is when the team owns a large percent of supply and artificially inflates the market cap. And with VC coins, they have a vesting schedule. So you can actually see this online. So it's a lot more transparent. With meme coins, it's not very transparent. But this is an element of the casino. It sits at the infrastructural level and it enables teams to extract. Because if you hold 90% supply, you can just keep dumping coins in the market. Don't you think the Brett team was doing that? Of course they were. And this is how they structurally design their casino. The chains and the airdrop mirage. So when Arbitrum and Optimism rewarded their users with a lot of free tokens, the playbook was born. Chains realized they could just sell hope in order to keep people on the carrot on the stick. What do I mean by this exactly? Arbitrum and Optimism did an airdrop. They gave people a lot of money. You didn't even need to interact with the chain much, and they gave you a few $1,000s per wallet, which is a lot of money. And then people started speculating on other chains. Okay, if Arbitrum gave this amount of people this amount of money, that means that this chain could give me X amount of dollars per wallet as well. And this encouraged people to start playing with the chain and start interacting with the chain. And this gave the chain a lot of money. And chains started using this process in order to extract fees from people and then giving them an awful, basically worthless airdrop. The cycles of extraction. Different mask, same machine. Every bull market dresses up exactly in the same way. It sells hope of making lots of money, but with a different tool each time. However, the structure behind the tool, it never changes. Insiders always control supply. Market makers are always going to shape the game. KOLs always shape narratives and metas. And we're going to go into a few examples of these different tools so you can understand how the casino has evolved over the years. So, ICOs. What are ICOs? Well, it was 2017 and it was the era of decentralized funding. This was actually 2015. This is wrong. It was 2015. We had ICOs where people were raising money for all of these altcoins. You had raised money for Ethereum and projects raised in ETH, but they delivered promises and then vanished. Insiders didn't just win, they wrote the new rule book. The ICO period was absolutely crazy. So much money extracted, loads of promises made, not many teams delivered. DeFi. So by 2020, some of you may have been involved in DeFi. We were what was called in the period of decentralized finance, where you can get lots of yield for the money that you put in. So your money works for you. People were printing millions from yield. Andrew Tate, actually, the way he made a lot of his first money was actually through PancakeSwap. You guys not be aware of it. He had a cousin called Luke. Luke's a very intelligent guy, and he is very, very good at crypto. And they bought a lot of Cake very early, and then they put it into Cake's protocol, and they were printing yield on that. Well, they were making hundreds of thousands of dollars every single day from this one play. If you got in early, you benefited and you made loads of money. If you got in late, you were the liquidity. Fortunately, that's how it works. And what happened is when the rewards dried up, insiders rotated capital elsewhere, leaving retail holders and tokens in dead ecosystems and leaving them absolutely gutted. NFTs, you guys will be aware of NFTs. In 2021, NFTs turned culture into speculation. It was everywhere. There were Discord groups. Everyone was buying NFTs. I remember Ether rocks were worth so much money. I don't even remember how much. It was worth like hundreds of thousands of dollars. And it was really simple. Playbook was get people to buy the NFT and never sell it. And actually, I believe the stat is that 90% of minted NFTs never got sold into the market, which is crazy, which basically means that 90% of people bought NFTs, minted them, and never sold them, which is crazy to me. Airdrops as well. The airdrop meta proved that crypto could extract without even launching a token. And this was the first time that retail was extracted from the use of anticipation with the carrot on the stick, right? And a tactic used by many, many chains. And meme coins, in my opinion, were the most amazing and most organic form of extraction because they didn't lie to people. People knew what a meme coin was. It wasn't tech. It wasn't revolutionary. It was the purest form of the casino. And in my opinion, one of the final forms of the casino as well. It removed all the need for tech and utility. People kind of knew that it was fake. And people knew that crypto didn't have much utility. So it started off fair, but then became structural extraction. Meme coins started off having a fair distribution, no market makers, no KOLs, no insiders. Well, obviously they're going to have some insiders, but not many. As things progressed, things became more structured. market makers became proper businesses, right? KOLs became institutionalized. The meme was at the top of the Seoul casino, 1% supply, 50 Seoul for them to call. That was the kind of meme. Insiders seeded supply, KOLs distributed meta. It was the only method, and it was that didn't bother to lie. Every other method lied. This method didn't, and that's why it worked. Once meme coins hit their peak, the machine had fully matured, and what remained was the truth traders never see, because these metas weren't accidents or trends, they were symptoms, and the cause was much deeper, a fully engineered hierarchy designed to extract from traders at every single level. So this is the era of the extractions. ICOs, DeFi, NFTs, meme coins. I forgot to add in airdrops here. There were a few different ones as well, but I would say these were the main ones, guys. So the reality is that crypto didn't stumble into this design of the casino. It matured through a system of natural incentives. And it's natural when you have a financial system that you can extract from. Professional operators will come in and take advantage. And this has happened in every single industry, whether it be traditional finance, whether it be tech, any industry where there are lots of profits to be made, you're going to get professional operators coming in. Crypto was an extremely lucrative one. The system was built for freedom, but now it literally, like, you have to play in the system that they all built. You have to use an exchange. You have to use, you don't have to use an exchange, but you have to, if you want to swap tokens, you have to use a decentralized exchange. There's no two ways about it. Like, unfortunately, you are forced to play in their system. And the hierarchy in crypto and the casino is pretty clear. So at the top, it's exchanges. And they're basically modern banks, and they pretend to be on your side. They like post memes and stuff, but they're not on your side. Below them, you have market makers, and they're the invisible engineers of motion. Then KOLs, which are the loudest, and they're the bridge between the market makers, exchanges, and retail. And at the bottom, it's retail. And that's the true fuel of the system. And the perfect trap, because casinos reward noise and punishes patience. It doesn't want winners, it wants players. And the design of the casino was perfect. You can win the casino sometimes, but the casino and the house is always right. The elites designed the casino. The edge is in seeing how it's made. And once you do, you stop playing their game and you actually start running your own.